All right, so chapter 3 starts with discussing how we handle consolidation of two entities that continue to exist after one of those entities is acquired by the other, subsequent to the date of acquisition. If you recall, in chapter 2, we saw some consolidation entries that were made on the day of the purchase. I'm not sure why you would do that, but I think the point was they wanted to point out what a consolidation of these two companies would look like on the date of the acquisition. And so we had the S entry where we dealt with the common stock and additional paid-in capital and retained earnings of the acquired company were taken out, and as well as the investment, the book value of the investment in the acquired company. And then we had the consolidation entry A. That's where we added the market value, the amount above book value of certain assets of the acquired company. And then that was, your credit was to further reduce the investment in the acquired company by the amount of the investment that's over the book value, the excess of book value. So those were your two entries. Well, what happens is, whether it's 1 year, 5 years, with the passage of time, several things happen. And so this passage of time complicates matters because you have other things that occur. Income in the subsidiary occurs. Dividends occur, amortization occurs, depreciation occurs. You have possibly intra-entity obligations as well, such as a note payable due by the shareholder or by the investor, the parent, or due to the parent from the sub, I guess I should say. So these things complicate the consolidation process. And so we're going to look at not only the S and the A consolidation entries, but some other entries that you have to make because of the passage of time. But realize that these entries are not made in the accounting records of either the parent or the sub. These entries are made on this consolidation worksheet that is separate from the actual accounting records. It's a play-like record. It's something you do once a year at the end of the year when you're reporting your consolidated financial. So this has no actual effect on the accounting records of either the parent or the sub. It's simply for external reporting purposes. But internally, what does the parent do? Well, they're going to report this investment in the sub at, well, certain ways. one of which you've already looked at. And so objective 1, we're going to look at the complexities in preparing consolidation or consolidated financial reports that emerge from the passage of time. I kind of already talked about that. Creates complexities for internal record keeping, and the balance of the investment account varies due to the accounting method used. Well, assuming the sub has net income, that's going to change your investment or the parent's investment account in the sub. And then, of course, dividends are going to decrease that. Especially if you use like the equity method. We'll show 3 methods here. We'll briefly talk about 2 of them. We'll mainly concentrate on the equity method when we're doing our consolidated worksheet, because if you can understand the equity method, you can definitely understand the other 2. But I would suspect that the equity method is widely used, much more so than the other 2 methods we'll talk about. So there are many reasons why we're focusing in on the equity method. So again, a worksheet and consolidation entries are used to eliminate the investment account and record the subsidiary's assets and liabilities to create a single set of financial statement for the combined business entity. And so the next thing, and that really was what I was getting at, is to identify and describe the various methods available to a parent in order to maintain its investment account. Remember that their accounting records on how they record this investment account is quite different than what we see in the consolidated financials. They're going to record this investment as an investment in the subsidiary on their internal accounting records. And how they account for that investment varies with what they're trying to achieve. And so there are 3 main methods for accounting for an investment in the acquired company by the parent. And so for each subsidiary owned, an asset called the investment account and an income account are created to record the earnings on the investment. Okay, so you've got your investment account, that's your asset, and then you've got an income account, your earnings on that investment in the sub. So the acquiring company selects one of 3 methods that have emerged as the most prominent to account for its method. One of them you've already seen. And so that's the one I want to focus on, the equity method. It is full-blown accrual accounting. You are recording the purchase of this investment at its fair value, and you allocate that fair value to the various assets. Any excess is goodwill. You account for income in your investment. You account for dividends received. That reduces your investment. The income increases investment, obviously. And then you have to deal with amortization and depreciation as well of the excess fair value over book value of the assets during their useful life. So it's everything you did in Chapter 1 when you were dealing with the equity method of investments. Now there it wasn't the full, you didn't own the full subsidiary, you owned part of it. So that's the only difference. It's still the same method. Now the initial value method, a little different. Basically, all you're doing is keeping it on the books at its cost, and then you wouldn't report any income. You would just simply report I take that back. You report income and any dividends that are declared. And of course, the income increases the value and the dividends decrease the value of your investment. I take that back. The parent recognizes, I was correct the first time, the parent recognizes income simply from any dividends when declared. They don't deal with any sort of income earned under the subs accrual method of accounting. Income is only earned when cash received in the form of dividends. So it stays on, everything else stays on the books at its initial cost. Partial equity method, there the parent's going to recognize income accruing from the sub, and they're going to reduce their investment in the sub by any dividends declared, but they're not going to deal with any amortization or depreciation. So here are some of the advantages to each. I think probably the equity method is the most prevalent. It gives a true representation of the consolidated figures. So for that reason, that's what we're going to cover in this chapter. And here's stuff we just talked about. So equity, we continually adjust to reflect the ownership in the acquired company. Incomes accrued as earned, amortization and depreciation and other adjustments are recognized with the initial value remains at initially recorded cost. Dividends declared are recorded as dividend income. You've seen that before, haven't you? In Chapter 1. Partial equity adjusted only for accrued income and dividends. No other adjustments recognized. Okay, so next we're going to look at this example they have. And so in this example, starting on page 88, parent company obtains all the outstanding common stock of Sun Company on January 1, 2014 for $800,000 in cash. Well, I'm going to get to it eventually. All right, so using the equity method, what we're going to adjust is the investment account for the subsidiary. And so the original investment recording at the date of acquisition is adjusted for fair market value adjustments and other intangible assets. What they're talking about there is when you have the excess fair value, you've got to amortize that over its remaining useful life. You also have to account for the parent's share of the sub's income or loss, and you also have to account for the receipt of dividends from the sub. It reduces the parent's investment in the sub. All right, so here's our example. And so Sun, the parent the sub, the balances are shown. So the book value of the assets assumed and the liabilities, assets acquired and liabilities assumed, the net book value is $600,000. The fair value of those assets acquired and liabilities assumed is $720,000. Again, they're purchasing, Parrot is purchasing Sun for $800,000. So you kind of already know that you've got $80,000 of purchase price not identified to any particular asset. And so if you recall, we have to assign that to goodwill. And so your differences are over there. Notice here we have kind of an unusual thing. We have some equipment whose fair value is actually $30,000 less than its book value. So we have a negative amount there that we're going to have to deal with. Okay, so far so good, hopefully. So 100% owned by Parrot Company. So here's our allocation of the acquisition date sub fair value. You subtract the fair value of consideration transferred from the net book value of the sub, $600,000. You have excess fair value over book value of $200,000. And then you're going to allocate that to specific accounts based on their fair value. Trademarks, $20,000. The fair value is $20,000 greater than its book value. Patents are $130,000 more than their book value. And equipment is overvalued, the book value is. So that's a negative $30,000. So all that's allocated at an amount of $120,000, leaving you with excess fair value not specifically identified to any particular assets, which we know as has to be booked to goodwill. Remember that we have to amortize and depreciate certain assets. We have to amortize and depreciate the excess fair value over book value over those particular assets' useful life or remaining useful life. Now, in this instance, we have an asset called trademarks. Again, the allocation of the excess is $20,000 to trademarks, but it has an indefinite useful life. And so recall that for intangible assets that have an indefinite useful life, you do not amortize that amount. You simply test it each year for went blank. Impairment. But for these others, what you have is patented technology. Our allocation of the excess fair value to patented technology is $130,000. Its useful life is 10 years, and so your annual amortization for that is going to be $13,000. While we're at it, goodwill, $80,000, also indefinite. And again, you're going to have a separate assessment from trademarks about whether or not goodwill is impaired. And if so, there's going to be a loss. We'll talk about that at the end of this chapter. Now, the unusual thing here is we have an allocation of a negative $30,000. The fair market value of the equipment's actually $30,000 less than its book value. And the remaining 5 years is, the remaining useful life is 5 years. And so this is kind of like what you may have seen or hopefully saw with bonds issued at a discount. In the case of bonds issued at a discount, you had to negatively amortize that amount over its life, the life of the bond. And so it actually increases the amount in the equipment account, so that at the end of 5 years, what you're going to have in there is not $120,000, but $150,000. So it's very similar to amortization of a discount on the sale of a bond. Bottom line is that the net annual amortization is $7,000. And so amortization here will be $7,000 annually for the 5 years that you have this equipment, its useful life. And then, of course, in years 6 to 10, it's going to be $13,000, because the $6,000 negative amortization goes away. Assume further that Sun Company earns income of $100,000 in 2014 and pays $40,000 cash dividend on August 1, 2014. And so here are the parents' financial records. They book the initial investment in Sun Company, and remember, this was a cash deal, so reduce cash. On 8/1, they record a dividend receivable, and the credit goes to reduce their investment in Sun Company. So that should look familiar to you. And of course, a couple of days later, they receive the cash and just simply remove the dividend receivable. So that should look familiar. All right, so you come up to the end of the year, 12/31/14, and parent company recognizes its, it increases its investment in Sun Company and a corresponding increase in the equity in subsidiary earnings account because of the $100,000 that Sun Company earned during the year of 2014. Recall, parent company owns 100%, so they recognize in their investment account 100% of Sun Company's $100,000 income. And then on top of that, you have your amortization, your yearly amortization you deal with, which is going to reduce their investment. So you've got equity in subsidiary earnings of $7,000. That's the net amortization amount that we saw on the previous screen. And of course, reduction in investment by crediting investment in Sun Company. Okay, so those should be fairly familiar to you by now. And again, this is using the equity method of accounting. So what do we have to do to consolidate? Now we're here at the end of our first year. We've got to give external reports to our investors, to our bankers, et cetera, et cetera, et cetera. So we get out our handy dandy worksheet, and we're going to make the following adjustments. Again, the first two should be familiar. You're going to make your S adjustment, your S entry on your consolidated worksheet. What this does is it eliminates the subsidiaries' stockholders' equity account, beginning balances, and the book value component within the parent's investment account, just like you did in Chapter 2. And so, fortunately, it's the same amount, I believe, $600,000. Next, you're going to recognize the unamortized allocations as of the beginning of the current year associated with the adjustments to fair value. Essentially, you're going to add the unamortized fair value allocations to the appropriate assets, and your corresponding credit is going to be to the remaining amount in the parent's investment account, just like you did in Chapter 2. The only difference is that here you might have some amortization that's been applied to the excess fair value of some of these assets. So the amounts might be different because of the passage of time and the effects that amortization has had on these assets, value or numbers. They've gone down in the case of the equipment, they would actually go up. All right, so those two entries, consolidation entries on your worksheet, you should be familiar with. Now the next two are fairly straightforward. And, you know, if you want to, not that we have any closed book exams around here, certainly not for you online people. I mean, I don't know how I would enforce that. So it's not like you have to actually remember this, but you know, if you want to use the term or the acronym SADI, that's what this is. You have to go through and do your SADI entries on your consolidation worksheet. Yeah, I realize it's spelled differently, but whatever. All right, so the next one you want to do, and could you do these differently? I guess, you know, you might be asking yourself, well, could you do EDIAS? Well, yeah, you could. I mean, there's no hard or fast rule. I've taught out a book where actually it was, let's see, what was it? SEADI, SEADI was the acronym. So I don't really care, but I guess for purposes of understanding, since the book does SAIDE, SAIDE, we'll continue with that acronym, SAIDE, SAIDE. All right, so the next entry, the I, eliminates the subsidiary income accrued by the parent. Well, that was essentially $100,000, but if you recall, there's excess amortization here of 7 that reduced income, so the net effect is $93,000. If you recall, we have dividends of $40,000, so you have to eliminate that entry on the parent's books because they're going to recognize all the income. And then E, since we undid our amortization in our consolidation entry I, we have to go in and re-enter separately these amortization expenses for the current period from the original adjustments to fair value. So without further ado, let's just look at those entries. Okay, so again, here we're simply reducing the common stock and retained earnings account of the sub, and your credit is to your the book value of the amount of investment that the parent company has in the sub, $600,000. Now, if, let's say, the point here is if Parrot bought this company mid-year, let's say, and so Sun had some income, that income that they earned prior to the acquisition would have to be added to retained earnings. All right, here's your entry A. And so you're adding to the sub's assets the fair value over book value. And note here that in the case of the equipment, you're actually reducing that by crediting equipment. And then of course the difference is the the excess fair value over book value that is assigned to the acquisition amount, 800 minus 600. Now note here, we didn't have any reduction in these amounts here due to depreciation or amortization, but in subsequent years, these numbers will go down. Well, trademarks won't unless there's an impairment, and goodwill won't unless there's an impairment, but you've got this amount that will go down, $13,000 a year. This amount will go down $6,000 a year. And so at the end of year 2, what you will show here is 117. What you will show here is 24. All right, so here's your consolidation entry I dealing with income. Entry I removes son's income recognized parent during the year, so son's revenue and expense accounts and current amortization expense can be brought into the consolidation totals. The expense accounts they're talking about will be done in consolidation entry E here shortly. And so note the amount they're including in consolidation entry I is the son's net income less the amortization. In this case, the net amortization was $7,000. And then consolidation entry D removes the intra-entity transfer of cash for the dividends. And so we increase investment in Sun Company and decrease dividends declared or dividends receivable or something. Or just plain dividends would do. And then, since we kind of undid our amortization depreciation expense, that's what entry E is we have to include these in the books of the consolidated company by rebooking this. Here we're booking an amortization expense of $13,000 that reduces patented technology account because that's your offsetting credit. And then here you're doing negative amortization on the equipment, so you're increasing equipment by $6,000, and you have a negative amortization or depreciation expense here, so that's $6,000 credit. I know that's kind of weird, but again, it's just like what you saw or should have seen in amortizing for bond discounts. So I'm kind of glad they're showing that here because it kind of gives you that twist that you might not otherwise see. All right. The only other consolidation entry that you might have is consolidation entry P. And if you look at Exhibit 3.7, they have an example of an intra-entity debt of $40,000 owed by the sub to the parent. And so the only thing you do there is you take the note payable out of the parent's current assets. And so you would credit current assets for, in this example, $40,000. And you would debit liabilities for $40,000. You're taking it out of the sub's liabilities by debiting that $40,000. So that's the only other entry that you might have to make if there's intra-entity debt. Now note here, regardless of how the parent records the sub's activity, whether it's equity method, it's the partial equity method, or the initial value method, the numbers are going to come out the same. So I gave you the more complicated method. You're welcome. Probably the most used method. If you can do the consolidation entries for a company that uses the equity method in accounting for its investment in the sub, you can do the other two very easily because they're not as difficult. So you have less entries that you have to eliminate with the other two methods, is what it boils down to. Now, I would urge you to look at Exhibit 3.6 and Exhibit 3.7, because what this does is it gives you an idea of what happens with the passage of time. Income happens, net income of the sub happens, and so the parent's investment in the sub increases, the sub's retained earnings increase, and so you have these amortization adjustments that affect the books. And so I would urge you to look at how those are treated in this addition to the problem we just went over that they talk about in well, from 95 to middle of 98. There they introduce this intra-entity debt and talk about what happens with the increase in time. And in this case, what they have is 3 subsequent years to the date of acquisition where income for those 3 years is $330,000, Sun Company declares dividends during those 3 years of $110,000, and so the net effect of that is an additional $220,000 and then during that time excess amortization for those 3 years is $7,000. So that you've got an increase of $330,000 to the investment account and a decrease from those dividends of $110,000 and a decrease in the investment due to the excess amortization expenses of $21,000. And then you have, I guess they're doing this as of the fourth year after acquisition, because you've got 3 years, 14, 15, 16, and then the current year, which is December 31, 17, that you have to deal with. And in that case, they have $160,000 net income. Sun Company has dividends declared of $70,000, and again, your excess amortization expense of $7,000. So look over that. Note that as of 12/31/17, the investment in Sun Company recorded on parents' books is $1,072,000. The bottom line figure in Exhibit 6 transfers over to the parents' books in their balance sheet in the consolidated worksheet that they have there. And note that, for instance, consolidation entry A, in the initial consolidation, the amount of $200,000 was entered, but now you've had 3 years of amortization, so that amount is now $200,000 minus 21, or $179,000. So actually, you know, if you want to start with the S, you've got 600,000 plus the 220 in net income minus dividends declared. So that's your book value. 820 is your credit, and then your debit's going to be to common stock, additional paid in capital, and $600,000 retained earnings of the sub. That's your debit. And then A, as I was talking about, your credit's 179, and what you're going to do is allocate to the various entity, or the various assets of the sub. So you've got your trademark, 20,000, that stays the same, no amortization. Goodwill, 80,000, that stays the same. Note that equipment, the patented technology is now at 91,000. So 130 minus what? $39. 130 minus 39. Three years of amortization. at $13,000 a year. And then you have your I part. And so there, you're debiting equity and subsidiary earnings for $153,000. You are crediting that $153,000 to your investment in Sun Company. Where's that amount coming from? Well, it's the net income for 2017 minus excess amortization, right? Let's see, D, that's your dividend. You're simply going to debit your investment in Sun Company account and credit dividends declared E, that's where you have to go in and make your entry again. It's the same entry we saw earlier. You're going to debit amortization expense, credit patented technology. Here you're going to increase. You've got a negative amortization situation, so you're debiting equipment and you're crediting depreciation expense. And then last but not least is your P, which is simply taking the notes receivable out of the parent's current assets and the notes payable out of the sub's liability account. So should be fairly cut and dried. Make sure you look at that and understand it.